Hello viewers, got a double whammy of a video for you here. I'm putting together the Ichimoku indicator, the tool, the trading suite with Renko. First part of the video, all about Ichimoku for those who are a bit unfamiliar with that part of technical analysis. Then moving into the world of Renko and why I like using Ichimoku with Renko, and then finishing off with a fantastic strategy that combines the two that you can take away, pull to pieces, using your own trading, do whatever you like with it. But I think it's certainly worth the next few minutes of your time to take a look at this video. So let's get into it. First of all, before we move into the world of Renko, we've got to fully understand what Ichimoku is, how it works, its component parts, all those pieces that once you do understand it, you can manipulate them yourselves much better in your own strategies or in other chart types. But in this instance, we can manipulate them more in the world of Renko. So what exactly is Ichimoku? Well, it's a unique trading tool for analysing any asset in any time frame or chart type for that matter. To the outside observer at first glance, it looks a total mess, but you untangle that and you've got a very straightforward, powerful, all-round trading system that can seriously boost your trading results. Ichimoku quite simply means one look. And by one look, we're meaning a collection of technical, analytical techniques all bundled into that one look. Trend, momentum, support and resistance, trading signals, entry and exit points. I said all bundled together in one technical indicator, which is why it becomes so powerful. Bit of history, developed by a guy called Gyochi Hosoda, Japanese journalist, back in 1969. Full name for Ichimoku, Ichimoku Kinku Hyoi. And it's basically made up of 5 indicators: the Tenkan Sen, the Kijun Sen, the Senko Span A and B, the Chikou Span, and note the Senkos create the cloud, which is also called Kumo. Now I've got the inputs for you there. Now those inputs, that's what were first thought of as being effective, but there's nothing to stop you, especially in today's charting packages, playing around with them and finding what works best for you. Now, a quick bit of Japanese translation. Now, I mentioned those parts in Japanese, but you'll find on a lot of the chart packages they are converted into their English equivalents. Now, as you can see here, the Tenkan Sen, that's called conversion line. The Kijun Sen is the baseline. Senku Span A is the leading span A. Senku Span B, leading span B. Chikou Span, the lagging span. I like to use the Japanese, but totally up to you. And like I said, most packages probably these days got it in English anyway. So that's what it looks like on a standard chart. That's the S&P 500. It's on Trading View. I've put on the Japanese and English equivalent parts so you can see what they are. But as you can see, first glance, it does look a mess. So that's why I like to spend a bit of time going through how it actually works, what the parts are, so you can fully understand it and then untangle it, and then it's not a mess for much longer. So let's start with the cloud first, the Kumo. That's a Senko Span A and B from the shaded area, and like I said, it's known as the cloud. And there are the inputs if you want to spend the time to learn how they work. And if you're in Trading View, for example, you can see how they put that chart together. So you can see now I've stripped back the other parts of the Ichimoku setup, just left on the cloud there. You can see the Senko Span A and B in action. The shaded areas, the greens and the reds, that's the Kumo and the cloud. So then quickly on to the conversion line and baseline. They're used for identifying faster, more frequent signals, similar-ish to Western moving average crossover type system. You can see there Tenkan Sen, the conversion line, 9 period high plus 9 period low divided by 2. The Kijun Sen, the baseline, 26 period high plus 26 period low divided by 2. Note the difference there to the Western moving average approach, though. That is not set on the close. It's that formula there you see there on a Tenkan Sen and the Kijun Sen. So the numbers, the output you get are slightly different to the standard Western moving average type of crossover system. And back to the S&P 500 chart, you can see the cloud there below the price action, but now you can start to see the conversion and baselines on there. There are two lines, the red and the blue, and you can see when they cross. Got a couple of bullish cross examples there in that chart type, but you can start to see how you could use them as potential signals. Now the Chiku span, the lagging span, is a very unique part of the system. It provides a link between the current and the previous trends and changes in those trends. Notice Chiku span is the close plotted 26 days in the past. And here again on the S&P 500 chart, you can start to see the components building up. We've got our cloud on there. We've got our conversion baselines on there. Now we've got that green line right at the top there, the Chiku span, or aka the lagging span. Now the cloud is a great trend filter to differentiate between the bulls and the bears, but also you can use it for gauging market momentum. The width of the cloud is also very important, signifying the volatility in the market and the strength of the trend in place. A thinner cloud, lower volatility and momentum. Thicker cloud is more bullish, bearish momentum. There's more scientific ways of identifying the overall trend using the cloud, and they're listed here, but I just like to take it quite simply. If the price is above the cloud, it's bullish. If it's below, it's bearish. And note the Senko, the edges of the cloud tell a story as well, and that's important when you get down into the micro analysis of the market you are trading. It's all about angles, as sharp up or down equals a strong trend, and combined with the Chiku span for confirmation. Curved could mean a possible reversal and can lead to a leading span A and B crossover, and if it's flat, it means neutral, price consolidation. So some useful rules there once you get a bit more experience in the world of Ichimoku. And if you really want to get into your Ichimoku, a bit more about the angles there's something called the belly down Kumo. It has a flat top and a lower belly. That's bearish, but can lead to a bullish trend reversal. And the belly up Kumo, basically the opposite, possible trend reversal there. As we'll see in a moment, this sort of stuff can be applied to the looking forward part of the cloud. When it comes to our strategy later, this sort of stuff isn't quite as important, but if you want to get into Ichimoku, very useful to know. So you might have seen in some of my other strategies I adopt the offset, forward offset, in various different indicators, but it's the same in Ichimoku, and it's a very unique concept in technical analysis, but it is also very highly effective. Now the cloud here is shifted 26 days, 26 periods forward, so as to provide a future view on the direction of the market, which is going to give us ideas around support and resistance, and like it says, potential direction. So let's get into a bit more detail around the conversion line and baseline. So if the conversion line is greater than the baseline, it's bullish, and vice versa, conversion line less than the baseline, bearish. And remember, bullish signals are potentially stronger when prices are above the cloud and the cloud is green, and bearish signals are potentially stronger when prices are below the cloud and the cloud is red. Note on the colours there, I'm using green as red, green for bullish, red for bearish, but these days you can change the inputs to whatever colours you fancy. Now when we're into our micro analysis, the conversion line and baseline slope strength can give us some important clues for potential future price action. The two lines, well, they're very great useful indicators for finding support and resistance levels and using for trade management. For example, you can use them as potential stop loss, trailing stop loss, that sort of thing. And the Chico span, the lagging span, well, that can be used to pick out bearish and bullish signals. It's perceived as a mirror of the price action in a typical trading period. So to use it, you must look for its position in relation to the position of the price action traced back to 26 candles previously. It's 26 bars. Think of it like another trend filtering or confirmation type of tool. So some basic rules: if the Chico span is above the price action, then it's bullish, and vice versa. And if the Chico is found where the candlesticks or blocks, when we look at the Renko, are, then this equates to possible consolidation, i.e. neutrality. And its main goal is for confirming support and resistance and flagging breakouts through the cloud. So I'm just going to quickly consolidate all the Ichimoku rules into one place. Hopefully this makes it easier for you. You can stop the video and jot them down if you want. Like I said, putting them together here just to give you a quick overall perspective of the Ichimoku system. So A1 there, the cloud. Kumo, Senko A, Senko B. If the price is greater than the cloud, bullish, vice versa, bearish. If the leading span A is greater than leading span B, bullish formed cloud, and vice versa. Micro analysis around that. The width and angles of the cloud, remember, important to ascertain the strength and momentum of the current trend. And the forward cloud, the Kumo. Utilize the forward cloud for support and resistance areas, and use the forward cloud as a potential guide to the strength and future direction of the trend. And the conversion and the baseline, well, if the conversion line is greater than the baseline, it's bullish, and vice versa. For stronger signals, use in conjunction with the cloud. Bullish signals are potentially stronger when prices are above the cloud and the cloud is green, and vice versa for bearish. And the lagging span, the Chico span, well, if that is greater than the price action, it's bullish, and vice versa for bearish. And if the Chico is found where the candlesticks are or blocks are, then this equates to possible consolidation. The beauty about the Ichimoku system is also, you don't have to use all of its parts at the same time. You can actually pick and choose. You can come up with your own rule set around them, adapt what you like into your strategies. And as we're saying, I've taken it further, using parts of it in combination with Renko. So hopefully that quick Ichimoku 101's helped you out, especially if you're newer to Ichimoku. You can now see how it works and how we've unscrambled what potentially to start with looks like a bit of a messy setup, but it all starts now to make sense. So now we shift over into the world of Renko and adding Ichimoku into that. Why do I think that is a good combination? Well, Renko, just focusing on the price action itself, really simplifying the price data, smoothing out the noise, whereas Ichimoku, that one-stop shop trading system, great for finding support, resistance, entry, exits, the trend, momentum. It's got everything in there that we need, and once we combine that with the simplicity of Renko, we create a powerful trading system. So here we've got the finished setup. Now I'm doing this on the S&P 500, ticker ES1, that's the E-mini futures there. I'm trading in the 1 minute Renko chart there, and you can see a block size that I'm using of $5 for the S&P 500. But let's first of all go through the indicators that we're using. At the bottom I've got the ATR indicator. That's the ATR of the Renko chart. Inputs wise 14. I'm just go up to the indicators tool and type in ATR. It should pull that back. Then above that I have the stochastic indicator set to 1433, and then we have our Ichimoku setup. Now I have got rid of the Chico span, don't want that. You can see the inputs that I've done. You can have the lagging span, the leading span there if we want it on. Just highlights the cloud. But we've got the cloud as we want it. So really it's just the conversion line, the baseline, and the cloud what we need there from the Ichimoku. And the last input there, you can see the light pink and white lines there. That's the super trend indicator. Got that set to 10.3, as you can see there. And that's basically all the inputs that we need. I've tried this on various markets, and I'll go through some of them after this example, what's worked and what hasn't. But this is the basic setup. Remember, it's the 1 minute chart. In terms of block size setting, I've used various periods of time. So I've looked at from the 5 minute to the 45 minute chart of the same instrument, say here the S&P 500, worked out the block size there, and then switched it, taking that block size from that time period, say 15 minutes, and then taking that into the 1 minute window, so we get more granularity around the price action, and then just gone into the settings, set it to traditional, and typed in the block size. So that's how I've done it. So you can basically stream this strategy to be as quick or as slow as you like. You could go faster than the 5 block size here if you really wanted to. So like in the S&P here, you could range anywhere from say $2 up to $20 block size, depending on what you're trying to achieve from the strategy. So let's dig into the rules. So the rules, I'm going to look at a bullish example here. It's exactly opposite for bearish. So rule number 1, the cloud. Remember, there it is. If it's above it, bullish; below it, bearish. We want the cloud in this instance to be green because it's bullish. We want it to be showing an uptrend. So basically Senko span A is greater than Senko span B. Now we move to the conversion and the baseline. That's the blue and the dark pink line, as you can see in there. And we don't want necessarily the cross of the two lines, which you can see occurring just there. You can take that into consideration if you want to, and it does equate in the rule set. But initially we want the price, the blocks, to close above the two lines. So if we're looking round about here, we can see that for example is above, that for example is above, that for example there is above, closes above there, etc, etc. So that's the two starting rules, and then we need the super trend to be confirming a positive trend. Now where's that super trend hiding? There it is. There, it's that white line you can see going up there. That's bullish, and we've got its bearish counterpart over there. So yeah, that's flicked to green. So we go there. Here we got the price above the two lines, and it's above the cloud there. So it's all looking very good. But the final piece of the jigsaw is this stochastic indicator below. And at that time, when all this is happening, we've got the close going on. We haven't got the final piece, like I said, which is the crossing of the stochastic indicator. And there, actually a bit later, let me just remove those drawings. You can see it happening. At the time we first looked, we were in the uptrend. We're going to wait until that crosses back again, which was roughly about here. So then you can see we've got the green cloud, we've got the price closing above the two lines, and we've got a bullish super trend indicator, and that is our trigger to buy. So we're going in long here for our up trade. So the next question is, what are the I suppose stop loss and take profit rules? Well, that's where our friend at the bottom, the ATR, comes into play. And as we go down through that string of combination of rule sets, we've got the ATR here. And at the time The ATR is roughly $6.50. So for stop loss, we're taking a 1.5 ATR. So we're talking just around about $10 maybe as our stop loss from our entry point, which in this trade was around about 5567. So we're looking at 5556. You know, it's a tight stop, but it gives us our nice risk returns. If you want to be a bit more conservative, you can increase the ATR, but these are short-term trades, and we're looking for a lot of in and out action. So in terms of take profit, I normally look at something like a 2 times ATR. So with 6.5, maybe we're looking for a $13 up move. So we're not actually looking at any other signals. In this instance, we're using the stop loss to bring us in, you know, around about here, quite tight, and our exit from the ATR to the upside. So we've got 1.5 ATR stop loss, 2 times ATR take profit. And a way to continue in the trade is by utilizing a trailing stop. So what often I do is, once the trade's moved in my favor about 1.5 ATRs, so in this instance, so you're talking, you know, that about that $9–10, I then start to trail the stop loss, you know, bring it to break even, or using that trailing stop loss that follows the price a distance of roughly 1 ATR. You could also consider other types of stop loss, you know, exit, you know, take profit type points. You might have your stop loss below the tight super trend there, for example, or below the conversion baselines. As we know, they're very good for support resistance, stop loss risk management type measures. Or, you know, we could have the stochastic down here for, say, the exit. You know, we could get out when it crosses. That's going to, I think, probably create a few whipsaws. So you might want to research a slower stochastic setup there. But like you can see, there's many alternatives to the strategy. It will also work pretty well, especially this like trailing super trend type approach, or, you know, using the conversion and baselines to follow up as well. But it's a pretty simple strategy. Looks a bit messy to start with, but, you know, once you've broken it down into its parts and put it together, it is quite straightforward. So what sort of results did I get for this strategy? So what about results? Well, here in front of you, we got it for the S&P 500. Got actually another block size I tested, $1.50. A lot faster, a lot more tricky to trade. The stats look better, but I can tell you it's a very hard one to deploy in practice. So running down the numbers there, you know, hypothetical account size of $10,000. You can see the inputs. Risking 1% per trade. Win rate about 65% on the $5, 72% on the $1.50. Decent Sharp ratios, hovering around 2. Profit factor not too bad. Drawdowns also, you know, pretty decent, 7%, 5%, so nothing too drastic there. And average trades per day, you can see it's quite good. It's 2 to 3, 3 to 4 opportunities per day. You can see the total number, rounded them up, 550 and 850 trades there, and the annual return on that strategy 35% and 45%, so pretty decent there on the S&P 500. I did try it on other markets as well, got some similar-ish results, just maybe S&P stood out probably as the best of the bunch. What other markets could you consider taking a look at for this one? You can see other markets I briefly looked at. I've also included the block sizes to get you going on those different markets as well. We can see the win rates consistently between sort of mid 60s to 70% percent, you know, similar sort of sharp ratios again, hovering around the 2, and a similar amount of opportunities per day in the strategy. You can sort of see the average annual returns as well, anywhere between 30 and 45%. I just included the volatility column in there to suggest to you, you know, the I suppose the asset type, and you know, bear in mind when you're playing around with the block sizes what you have to do to create more consistent returns and not maybe get whipsawed out of a lot of the trades. For example, Bitcoin, there you can see a block size of around $500, very high in terms of volatility, whereas maybe something with a low moderate volatility like the Euro futures there, I think that's the Euro USD, you can see I'm only using a 5 point block size there, 0.0005, just to generate similar type of results. So a table there to give you some ideas and for something, you know, you can take away and play with. So there you go, Renko and Ichimoku together. I think you can see quite powerful the way the Renko clears out the noise, allows you to focus in on the price action, allows indicators like the stochastic and the super trend to work more efficiently. And then we're using the Ichimoku tool with the cloud and the lines that we've seen in there to help us create entry points, understand the trend, you know, also help us with our trade and risk management as well. We've looked at ATR methods of taking profit and setting stop losses, trailing stop losses in there as well. So a whole combination of stuff that you can go away and play with. And if you were new to Ichimoku, hopefully now you can see how all the different parts work, or if you had familiarity with Ichimoku, maybe you've learned a bit more about the rules around the system. But the other beauty of Ichimoku is the way you can strip it to the parts that you want to use and add on other indicators and tools in combination to create powerful trading strategies. Love to hear from you. Do you use Ichimoku on the Renko charts? Do you use a different setup, got different strategies? Like I said, get those comments coming in. Love to hear from you there. And if you've liked today's video, please give us a thumbs up. It all helps the channel. Don't forget to hit the subscribe and notification buttons to receive future heads up around content that I'll be producing on the channel. Now, if you want to learn more about the Renko charts, you're new to Renko, got a great playlist on my YouTube channel. Takes you from hero to zero in the world of Renko. Work your way from the top to the bottom, and like I say, you'll come out the other side a master of the Renko chart. And that playlist is coming up right now.